Michael Saylor proposes that when you invest in his company, that it's the best tax advantaged investment you can have. There's no taxes on it. This is only on the short term. All right. So he's saying that when they pay dividends out to shareholders, they're doing it by selling equity. And since they're selling equity, that the payout, rather than being a dividend, is actually a distribution or return on equity, which is not taxable. Return on equity means we're giving back your money. And he explains in an example, let's say you put in $100 and have a return of equity each year of $10. What happens is that your cost basis on that investment goes to $90, the reduction of that. So there's no tax. But take that example out 10 years. So the first 10 years, it's reducing $10 until you now have zero equity in the company, although you do have an investment. What happens in year 11? Well, that distribution is now a dividend rather than a return on equity, so you will pay tax on it. And secondly, when you sell that asset, because you've had return of equity reducing the basis, now the entire sale is treated as a capital gain. The entire amount, because in that example, you're going to get down to zero basis. So when you sell it, let's say instead of being worth 100 initially, now it's worth 200, it's 200 of capital gain then. So while it is true, it is a extremely attractive tax-free investment for the first, in his example, 10 years. After 10 years, it's all taxed. And when you get out of it, you're substantially taxed. Rather than being taxed on $100 gain, you're being taxed on the entire $200. Let's just say it's backloaded on the tax elements rather than tax efficient.